How is wealth extracted from a country? Many are scratching their heads in trying to understand how a nation that was once as wealthy as the United Kingdom can have been reduced to a spiraling financial crisis. While classical explanations, such as running a trade deficit for 50 years, erosion of its industrial base, the sale of its resources and infrastructure to foreign concerns, and relying increasingly upon financialization and services rather than finished goods and commodities, might go some way to explaining the rapid downturn in the nation's fortunes, they do not necessarily provide the entire picture. The United Kingdom retains a wealth of fertile farmland, oil and gas reserves, an industrious, well-educated workforce, abundant fresh water, and advanced infrastructure, and all the fruits of a well-positioned maritime nation. So, how can a nation with such natural wealth become so poor? The first logical statement infers that a perennial inflow of wealth must remain within the nation's economy, unless it is somehow expatriated. If it was simply a question of wealth distribution within the state, then introducing wealth taxes might be a theoretical solution. However, this is not the case. The first obvious statement of fact is that a great proportion of the revenues generated from the UK's industry, retail sales, and utilities, including water and rail, flow overseas to corporations registered in low-tax jurisdictions like Luxembourg, Ireland and Jersey. Consequently, the UK may only receive income from labour, sales and property taxes, given that many of these corporations are registered overseas. Similarly, dividends from profits may be dispersed to shareholders who are resident overseas, or who claim domicile in tax havens, or to shell companies and trusts registered offshore. The other thorny issue, as demonstrated by the 90% top rate of tax introduced in the 70s, is the flight of capital. This simply means that multi-millionaires and billionaires are mobile, and can swiftly expatriate both themselves and their income, using diverse trusts, shells, and tax havens to obfuscate their wealth, which can often take the form of yachts, properties and other assets registered in overseas jurisdictions. This is, after all, the very purpose of the construct of a digitally based financial system, one that is not based on the transfer of an actual physical resource or commodity, such as land or gold. So, of those remaining UK citizens who have not formally abandoned the UK, through which channels can wealth be legally expatriated? At present, the wealthy can legitimately invest in foreign stock markets, real estate or businesses, or simply transfer income to accounts held in foreign banks. They can also buy cryptocurrencies, pay for services rendered overseas, or buy valuable assets such as works of art, and lend them to foreign galleries or museums for later recovery. In terms of the illicit offshoring of wealth, unscrupulous millionaires could conceivably manipulate the declared value of imports or exports to move funds, use opaque legal entities such as shell funds or trusts in jurisdictions offering secrecy to obscure ownership and move funds, or else smuggle gold or artworks by yacht, ship or private jet. What is the economic impact of wealth extraction? First, we have witnessed the erosion of the tax base. When wealthy individuals move assets and income out of the UK, it logically reduces the tax revenue collected by the government. This could lead to cuts in public services, or the need to raise taxes on remaining residents and businesses, leading to a vicious spiral of taxation, as the UK government tries to balance the books. Consequently, a shrinking tax base can exacerbate wealth inequality, potentially leading to social and political tensions. Second, the expatriation of wealth on a massive scale unequivocally signals a lack of confidence in the UK economy, potentially triggering a further flight of capital, discouraging foreign investment, and increasing the interest rates on government borrowing. As wealth flees the country, it means that less capital is available for domestic investment in businesses, infrastructure and innovation, further reducing national wealth and tax revenues due to impaired economic growth and job creation. Third, the declining economic fortunes of the UK threaten a brain drain of many of the most highly skilled and educated academics, researchers, engineers and technologists, negatively impacting innovation and productivity. Such expatriation leads to fewer individuals who are able to attract the capital and to successfully start and grow businesses within the UK. This explains much of the UK's current financial woes, as the very tax increases that the government introduces to repay the nation's debts and maintain the public sector exacerbate shortfalls in private investment, retail spending and innovation. This culminates in a vicious cycle of austerity, crime, the closure of leisure and retail venues, and rising unemployment as the government prints yet further currency to pay its rising debts amid economic contraction. a state of affairs we could term negflation, given the prevailing negative economic growth and rising inflation.